All right. So last few lessons were identifying levels, multiple time frame analysis, trends, technical levels, trade plan and back testing. Although we left out the back testing part, I'll revisit that when that session comes back around. So it's right now I'm doing 3 sessions a week, so it won't be long before any of these come back around. I'm going to knock out the math of account size and risk and all that right now, and I will then jump to an intro to some patterns. But the reason I put this in, the whole risking account percentage and trading evals and combines and the math of all that, is because I found that people were telling me that they were trading the micros looking to hit a certain profit target, but I don't think they were taking into consideration how long it would take to hit that profit target because you're trading micros. So I mean, the micros are great, clearly based on your strategy or based on your account size. You know how much you're willing to risk, and emotionally, it's going to be a lot more. For some people, or for most people, emotionally, it's going to be a little easier to watch your P&L ticking in $5 increments instead of $50 increments, or in $1.25 increments instead of $12.50 increments, right? So because the ES or the mini trades in quarter points or $50. This Control X. Do you trade the ES?
Not in futures. No, I'm mostly within equity and just dollar cost averaging right now.
Trading stocks, is that what you mean?
Yeah, stocks. Yeah.
Okay, cool. Well, this will still relate anyway. Since I trade futures. Most of the things I'm going to reference are going to be futures. So dollars a point, dollars a tick. So the ES is $50 a point, and your 12.50 tick. The micros on the ES are going to be $5 a point. So jumping back for a moment, if you are trading, say you're trading on, a lot of the, if you're trading a combine, for example, if you're trading with a proprietary firm like Apex, Apex they have, for example, a $50,000 account. That $50,000 account has a profit target of, I believe it's 3,000. Not mistaken, it's 3,000. It's 3,000 with 25, with $2,500 drawdown. So it's a 3,000 target. With a account size target and a trailing drawdown. So you don't want to risk per trade. It's kind of common practice, let's say, to not risk any more than 1% of your account. Some people say 2%, some people push as far as 3%. So if you're let's just look at this real quick so you can see the numbers on this. 2% and 3%, what does that look like? That was going to be 0.01 of that right there. Two, and there's going to be 3%. So if clearly in this case, if you're risking up to 1% per trade, you got 2,500 drawdown. But you lose 5 in a row, you're going to blow this account. Okay? So we don't even necessarily need to with regards to this account size even talk about whether you are willing to risk 2% or 3% of your account. So with 1% of your account, in this situation where Apex is a proprietary firm that you can trade with, and this will be your combine, and if you get funded, they'll have rules after that with regards to how much you can. Basically, once you hit your profit target, they will give you a funded account, and that funded account, as long as it doesn't go below $50,100 or $50,100, will be your drawdown before they close the account on you. So if you got a $3,000 price target, you're risking a max of $500. Cool. Let's say you, for example, all your trades. Let's say your trades are 3-1. Every trade you take, regardless of your strategy, you're taking 3-1. So this means you can take 4 trades, lose 3. Let's just look at the math on this for a second, right? So trade number 1, 2, 3, and 4. We'll do this. We'll do it in dollar value and we'll do it in point value, right? So let's say this. So if you're trading 3 to 1 and your risk is 3 points, talking about the ES for a second. So every trade's 3 to 1 with a risk of 3 points. Actually, I'm going to make this ticks. So 3 points is 12 ticks of risk, right? So if this 3 to 1 is a loss, there's a loss, there's a loss, there's a win. Where's that going to put you? You risked 12 ticks, so you're negative 12 here. And you're plus 36 here. Why didn't I get the appropriate number? Some C 12, 2, 22. Let's try that one more time. This should be, oh, that is correct. It's 0 because it's minus 36 and plus 36. Okay, so my point is, if you're risking 3 to 1 and you're trying to get 36 ticks out of each trade, if you're out, you're out, you're out, and you hit 4 trades, you break even, right?
Okay.
Over 10 trades, let's just do this. No, this is still gonna, if you took 10 trades, and you lost 7 out of 10 of those trades, you'd still be positive 24 points, all right?
Because you hit.
So let's bring this over to the value of winning and losing these trades in dollar value for a second. So this is going to equal that 12 ticks times 12.50 a tick. Okay. This is dollars. $300. And let's do the same thing in micros. So we'll actually just take this and we'll divide it by 10. That's going to get you there. And there. Okay. All right. So, what's the point of me making this right here? Well, first of all, I'm going to split this to here and show you how this is affecting your account. So if your account is 50 grand here, it's 50 grand here, is going to equal that plus that. Okay, we're going to make that constant. No, wait a minute. And this is going to equal that plus that, and then copy this down. So what's relevant here? You're risking 1% on any one trade. So you're risking up to $500. In this case, we're not even risking $500 because 3 points is $150 if you're trading one contract on the ES. So if you're trading one contract on the ES, 3 points every time is $150. You never hit your trailing drawdown here.
Yeah.
Now it's a trailing. Sorry, this is actually a trailing drawdown. So this will move up as you start to profit. As you start to profit beyond that 50,000 mark, right? So anyway, when you're first in this account, if you're trying to get funded in a prop firm, this is the situation you're going to be in. You're going to be minus, minus, minus. Okay, your account value, 49. We didn't get above 50. So here at this point where you got to 5,300, your trailing drawdown would go up from 4750 to 4780. The point is, if you took 10 trades, you might take 10 trades in a day, you might take 10 trades in a week, but you finish this week up $300, right? Now you're trying to get to $3,000. So we're going to simplify the hell out of this. If you did this every week, you took 10 trades every week, and this is how it went down. You lost 7 and you won 3. You'd be up $300 every week. So it's going to take you 10 weeks to hit this $3,000 price target. All right, fine. So
and the price target, right? What was that? The price target. So that 3,000.
Sorry, not. Sorry, I didn't mean to say price target. I meant to say profit target.
So the profit target of 3,000. When is that? When are you supposed to hit that? Is it on? Do you hit 3,000 every month, or just 3,000 period, and then it just keeps growing once you hit that target?
Okay. Are you asking the question in the context of what this proprietary firm?
What the rule is, I guess. Yeah. Okay. So once you have an account size.
Sure. The rule particular to Apex, for example, is you have to trade a minimum of 10 days. So you could hit this profit target in 3 days.
Yep.
If you hit 3,000, but you still need to continue trading. You need to have 7 more trading days, and you need to stay profitable to get funded.
Gotcha. So every 10 days you have to profit. Okay. But I just wanted to get an understanding, but related to this now.
Yeah, that's okay. Now, why do I point this out? I'm pointing this out because some people have decided to trade the micros. And if you're trading the micros,
your volume has to be higher.
Right. So here, let's just say we said this is what, let's just say every week you take 10 trades and every week you lose 7 and you win 3. It's going to take you 10 weeks to hit that profit target, right? But let's say you're trading micros, and this is trading. This is one contract. All right. If you do that in the micros, at the end of your week, if you took 10 trades, you made $30. All right. That's going to take you 100 weeks to get to your profit target. So my point is, and let's see, E7 D12. Okay. So, and you can see it works out the same here, right? So what's my point? My point is, if you're going to trade micros, you're going to need to do something different. You're going to need to either up the number of contracts.
Or the amount of
you're going to need to up your number of contracts, or you're going to need to go for a smaller profit target, right? So if we'll look at Apex's. I've traded on Apex. They have a $25,000 account that has a $1,500 price target. That's the only other one that would maybe make sense, because let's just say you push this to, let's just say you can't handle whatever the reason, your account, psychological, and this doesn't have to be through trading, by the way. This doesn't have to be trading through a prop firm. All right, so here I'll wrap this up real quick on trading through the prop firm. If you were going to do this with, let's say, 5 contracts. So if you couldn't stomach, if for some reason you can't stomach risking $150 a trade, but you're comfortable risking $75 a trade, then maybe you switch to micros and you trade 5 contracts on the micros. And this is what your scenario looks like after 10 trades. This doesn't have to be 10 weeks, but again, we were just saying, let's say hypothetically you take 10 trades a week. After 10 weeks, you're $150 in profit. And again, this is assuming that this goes the same way every week. Okay, clearly that's not actually going to happen, but we can't do every scenario. So in this context, you're going to be it's going to take you 20 weeks to get the profit. 20 weeks, 6 months, sorry, 5 months, right? 5 times 4 is 20.
Yeah.
So 5 months to get to that $3,000 profit target. Maybe your strategy is, if you're using a strategy that uses multiple entries, so you're averaging into a position, then maybe you switch over to micros, and instead of using the minis, and what I mean by averaging in, let's just say you're trying to get in at 50, 45, and 40, right? Which, if you were three minis, you'd end up with an average price. You'd end up 3 contracts at 45, right? Because 50 plus 45 plus 40 divided by 3 is going to give you 40. Is going to give you that mill price. So you're going to be in for 3 contracts at 45. But to be in for 3 contracts at 45, risking having your stop is going to have to be somewhere below your last entry. So that stop, instead of being 3, where it would have to be 3 points below your middle, is going to be a little tricky. But here, let's just say you were going to risk 3 points here. Your stop would be at 47, your stop would be at 42, and your stop would be at 37, right? If you were to take any of these independently, any price level independently, I'm not talking about any particular, I'm not talking about the ES or the NQ or Tesla stock. I'm just saying in general, the math on this is, if I'm going to risk 3 points I'm willing to risk 3 points on any trade. Well, if I want to be in at 40, then my stop has to be at 37. Okay, well, if I'm averaging my way in, for me, I would have my stop below my lowest entry at 37. But if you're trying to average your price in at 45, then yeah, 3 points below 45 is 42. But if you're trying to enter at 40 and you have a stop at 42, you're stopping yourself out to buy again here. And there may be people who do that. Doesn't, sure, 45 gets you out of 42, and then you get in 2 points lower. But the math doesn't really. If you just put all your stops at 37, your average price is 45. Then now, instead of risking 3, you are risking 5 points. So if you're risking 5 points, you gotta get creative with the math here, right? So if I'm gonna have 3 contracts risking 5 points, try and follow me here. Here's 3 contracts times what would be an average of 5 points times $50 a point is $750. If you're risking 1% of your account, which is $500, you need to do a little math here. So this is a way in which you can utilize the micros. Okay, so there's going to be that 750. That's how much you're going to risk on a trade. But you don't want to risk 750 on a trade. You want to risk 500. Well, the only way for you to risk 500 on this trade is to jump into the micros and reduce your exposure by, instead of taking 1 mini at each of these entries, you take 6 micros at each of these entries. And those 6 micros will total a risk of $450.
Gotcha.
That was a lot of messy math. Did you follow it?
Yeah. So you go with the micros because you reduce your risk exposure from 750 to 500.
You're reducing exposure.
Oh, your exposure from 750 to 500 to be within your 1% range.
I'm having trouble hearing you. Hold on a second.
Oh, sorry. Can you hear me?
Yeah, you were cutting in and out.
Oh, maybe it's my headset. Can you hear me clear now?
Let me just try this real quick.
All right.
Can you say something for me?
Yeah. Can you hear me?
Yes.
All right. No, I was saying by going over to the minis, you're reducing your risk exposure from 750 to 500, and being within that 1% tolerance.
Well, by going from minis to micros, because a micro is 1/10 of a mini, right? So if like we said over here, it's $50 a point on the mini, and it's $5 a point on the micro.
Yep.
Right. But if you're trading the ES, give you an example real quick. Just put this into sim. If you're trading the ES, and well, I don't know that being on the screen is really going to make a difference. So let me go back to here. So instead of 1250 a tick, you're 125 a tick, right? So we said over here that if you're gonna average into this trade, you want to buy here, here, and here. If you get filled on all of those, you want to buy here, here, and here, but your stop is going to be 3 points below your lowest entry. So that means your stop, if you took this 50 by itself, your stop would be at 47. If you took 45 by itself, your stop would be at 42. If you took 40 by itself, you'd be at 37. Well, if you need to be 3 points below that lowest entry at 37, but you enter at all of these, your average is going to be 45. So if your average is 45 and your stop is 37, the difference between 45 and 37 is 8, which means every one of these contracts, or even if it's shares and stock, if your average price is going to be 45 and your stop is going to be 8 points below that, then 8 times 5, sorry, in this case, it's going to be 3 contracts because we're talking about futures. So if you're trading 3 minis and it's $50 a point, 8 times 5, 3 contracts, 5 points, $50, $750, because your average price is going to be 45 and your stop is going to be 5 points away. 5 times 50 is 250. 250 times 3, because you're in for 3 contracts, is 750. Okay, but that's too high because I'm only willing to risk 1% of my account. So I'm only willing to risk $500. So now I got to, all right, how do I turn that? How do I not go more than $500 on this? And the answer is, instead of one contract, one contract, one contract, we're going to go 6, 6, and 6. So our average price is going to be here at 45.
Oh, gotcha now.
Average price is going to be here. 6 contracts, that's going to be a total of 18. Each of those contracts is worth $5. So this is right here, right? So each contract is worth, here, I'll do the math right in here. Each contract is worth $5. You multiply that by 5 points of risk, and you multiply that by the number of contracts. So you're risking $450 per trade. You're risking $450 on this trade.
Gotcha.
And then you're trying to take this 3 to 1. So 3 to 1 on 450. If you were to take it 3 to 1, you'd be about 12, 13, 1350 would be your target. If you because 3 to 1 is, when we say 3 to 1, you're risking 3 to sorry, you're risking 1, in this case, 1 being 450, the amount you're risking, and you want to make 3 times that. As if my math is correct, it's 450 times 3 is 1350, like I said. So, you know, this is, it's a way to it's using the micros as there's two reasons to be using the micro, 3 reasons to be using the micros here. What's like 3 reasons to be using the micros? There's more than 3, but here we'll name these 3. Okay. One is you just let's only talk mathematically. Forget about psychologically whether you can handle it or not. It's going to be, one reason is going to be account size, because you may not be trading inside of a prop firm like this, for example, right? You may just open an account with $5,000.
Yeah.
So if you open an account with $5,000, you know, your 1% of that is going to be $50, right? So account size is going to be one reason. Your second reason is going to be so you can scale in. And
our lower risk threshold.
What's that?
I would say lower risk threshold, which
yeah,
would probably be an account size.
That might be like the psychological.
Okay.
The psychological part of it, right? Because you know, this is going to be the 2 main reasons. I know I said 3, but account size and scaling in.
Okay.
Because if we put in number 3, okay, let's say would you say threshold, or what did you say?
If you had a lower risk threshold.
Yeah, risk threshold, right? If you had a lower risk threshold, okay, that's a reason. But if that lower risk threshold, if you do it in this scenario here, where you decide to trade 5 contracts, it's 5 micros instead of 1 mini, okay, right? Because we said if you're trying to get a $3,000 profit target, it's going to take 10 weeks if you trade the micros. If you trade half of that position size, 5 micros compared to 1 mini, it'll take you 20 weeks. Okay, like that's reasonable. But if you're going to go in and you're going to try and make a $3,000 price target, trading 1 micro per trade, going back to this, and going
Mhm.
back to this.
Take it
You're gonna
further.
make $30 a week. I mean, and you know what? I mean, I don't know. You make $30 a week. Well, I was gonna say you might be okay with that, but you know, $30 a week times 52 weeks, you're gonna make $1,500 a year trading. But you know what? We're talking about making these 10 trades a week.
A lot of time.
Um, you know, the amount of time you're gonna put into this, is it worth it to make $1,500 the whole year trading? I mean, if you're 16, I guess, and you're just learning this a few hours a week on a side thing, like, you know, also if you break it down to hours, and clearly you're gonna have a learning curve. You know, you're not gonna make, not many people are gonna make money right off the bat. Stuff takes years to learn. But again, you know, I thought about running through all this because um, I knew a bunch of people who were trading combines and prop firms, and were taking 1 and 2 contract trades on the micros, but had $3,000 and $5,000 price targets they had to hit.
Mm.
So it's not that you can't trade the micros, but if you're gonna trade the micros, like, you gotta do some math on it.
Yeah.
So that was the point in getting into this and crunching these numbers, and you know, sure, this is I've definitely gone a little bit off on a tangent, but to kick the math around, I think is really important.
No, this is very helpful.
So that, you know, that's how you would trade that effectively. I'm gonna wrap that there. I will elaborate on this again in the next, when I come back around to lesson 5 again in like 2 weeks.